which is quite different. Each time new figures came and suggested there would be a decline in the inflows, they revised the budget, which is quite different from earlier responses to crisis. That's a lesson we've learned, and it came as a result of better institutions in many of these countries. It came as a result of policies being better managed than before. Central banks in Africa are much stronger today than they were 10 years ago or 20 years ago. They've had a very uniform way of dealing with the monetary side of the equation. Finance ministries are much better structured today and better managed than they were 10 years earlier. So they were able to deal with the fiscal side much more so than in many other situations. And in those countries where the central banks and the finance ministries reacted responsibly early enough, were those like Zambia, like Tanzania, that were able to deal with it much, much better than others. So that's the lesson that we have learned. And I've listened to many African central bankers talk about the need not to go back on reforms. Many were those who are afraid that in the wake of these crises, our African governments will go back and say, well, there's no need for us to pursue these market reforms. What they've learned is that good institutions do pay. They've also learned that functioning policies can also pay. So having good policies, having good institutions can lead to a better containment of these shocks. Thank you.
Thank you very much indeed, Ernest, for that. We now turn to Michaela Urbanova, who's a lucky person. She was born in Prague and grew up here. She had a distinguished career here as advisor to the Prime Minister, as head of the group of advisors to the Minister of Finance, member of the government's steering committee for bank privatization. She was appointed a member of the bank board and chief executive director of the Czech National Bank. And more recently, in 2007, she joined the International Monetary Fund, where she is now Deputy Division Chief of the Financial Sector Oversight Division. We look forward to your comments. Thank you.
Thank you for your introduction, Andrew, and it's a great honor, of course, for me to be invited to this venue and to speak here. Now, whatever I say are my own thoughts without any official affiliation, despite the introduction, of course. But I will nevertheless try to outline where are we in the current crisis and what's been happening in Europe, with a particular emphasis on emerging European countries, and what are the policy challenges as a result going forward. Now, the global financial crisis did underline, in a painful way rather, I think, that we do live in a globalized economy, in fact, and problems which welled up in a rather obscure segment of the US housing market grew into the most serious global downturn since the Great Depression. But I would argue that it wasn't a surprise at all that we had a global crisis of this magnitude, as the talk about the need to correct one way or another global imbalances has been a theme for the last 10 years or so, in particular framed as an imbalance between current account developments in Asia and China in that respect versus the United States, but more generally between large regions of the world. And so was the talk about the need to resolve, correct, or react one way or another to the liquidity overhang in the United States. So while the impetus for the crisis may have been a surprise, the fact that it occurred finally was rather a vindication of economic profession, I would say. Now, emerging Europe was particularly hit by the crisis, as it is vetted so firmly through trade and other links to the advanced European countries. The export markets dried up very quickly, pretty much within a year and a half or so for most of the countries in the region. And what was perhaps more important was the behavior of Western European banks. Now, Western European banks have largely financed unprecedented catch-up that occurred in Central Eastern and Southeastern Europe in the last decade. But they also stood behind a build-up of very considerable vulnerabilities, which were a dependence on external funding and a very large share of borrowing of unhedged households in foreign exchange. Now, what happened during the boom years was that the parent banks largely on-lent Western European deposits to their subsidiaries in South, East, Central and Eastern Europe, where returns to equity and assets were much higher due to the process of catch-up. And in the fall of 2008, those transfers stopped very quickly in the wake of financial crisis. In some countries, Western European banks even started reducing their exposure. And those were not only the usual suspects like Baltics and Ukraine, but also Hungary and Poland. And then the decline in inflows from parent banks had, of course, an immediate and very significant impact on credit growth. The extension of new credit stopped to a near halt in most of the countries. Now, we have heard a very inspiring lecture yesterday about sudden stops. This is what everybody feared immediately in this region, of course, seeing this development. And here, the consequences of a sudden stop in capital inflow were potentially even more painful, as the degree of financial sector integration in Europe is really unparalleled to other regions of the world. Foreign banks represent close to or over 90% of assets of financial sector in many of these countries I'm talking about. So the dependence on external funding is huge, and economic development is in many cases really very hard to influence by any domestic macro policies, no matter how consistent they are. Now, not surprisingly, the severe downturn ensued. Now, these charts speak about Central Eastern Europe, Central Eastern and Southern Europe, and they leave aside former Soviet Union, just to explain what they show, because there the developments were rather specific. Now, against this general background, what is interesting is that the virtue has been more or less rewarded even in Central and Eastern Europe, as the sharpest fall in capital flows and the hit to domestic demand was experienced by those countries which had largest initial imbalances, fastest credit-fueled growth, fastest real estate boom, or large external imbalances as evidenced by current account deficits and potentially overvalued currencies. And that relationship is very robust across these countries, as evidenced, for instance, by this graph, but also by more sophisticated analysis. Now, capital inflows are projected to shrink by more than 10 percentage points in 2009 compared to 2008, just within a year, in the Baltics, Bulgaria, Romania, Ukraine, and Hungary, whereas in the Czech Republic or Poland, the capital account shock was fairly moderate, if any. The particularly hard-hit region was the Baltics, where the EU integration gains in living standards were pretty much reversed within a year, and that was true for Latvia, Lithuania, and Estonia alike. Now, cumulative output contraction in Latvia between 2008 and 2010 is the worst in the world, and it is followed in this league by Lithuania and Estonia. And if you take the largest cumulative decline in output across the whole world, which is 198 members of the IMF, for which I have data, then out the 10 worst performance,